Good morning. The hearing will come to order. Thank you for joining us for our hearing today on the Ways and Means Small Business Tax Reform Discussion Draft. In March of 2011, the Select Revenue Measures Subcommittee held a hearing on small business and tax reform. We learned that the temporary complex nature of the tax code was forcing small business owners to invest their time and resources complying with the tax code instead of focusing on growing their businesses. The message was clear. Simplifying the code means more jobs created by small business owners. Indeed, comprehensive tax reform must result in a simpler, more stable code with lower statutory rates for small business owners. Today, 9 out of 10 small business owners rely on a tax preparer. There have been over 4,500 changes to the tax code over the last 10 years, and with the addition of the 3.8% Obamacare tax, small business pass-through entities which pay their taxes at individual rates will have a top federal tax rate of 44.6%. Comprehensive tax reform cannot be limited to an exercise of only lowering the corporate rate, as the President has suggested. It must also focus on lowering rates for small business owners who employ over 50% of the private sector workforce and whose tax compliance costs are 65% higher than large businesses. The Small Business Tax Reform Discussion Draft is a step forward in creating a better tax code for small businesses, but that's not to say it can't be improved upon, and that's why Chairman Camp has released this as a discussion draft to ensure that through a public, transparent process, stakeholders, including small business owners themselves, have the opportunity to tell us what they need from tax reform to help them create jobs, increase wages for their employees. Looking forward to a great bipartisan discussion today. I thank our witnesses for being here, taking time out of their busy schedules, and now I yield to Ranking Member Neal for his opening statement.
Thank you, Mr. Chairman, for calling today's hearing on Chairman Camp's small business tax reform legislation. Small businesses are the engines of job creation in the country, and nearly 60 million Americans work for small business. That's about half of our private sector workforce. When I travel around my district back in western Massachusetts, I'm amazed by the entrepreneurial spirit of the small business owners that I meet. These businesses manufacture medical device equipment and sophisticated plastics and paper. They brew great lagers, or as we call it in western Mass, great beer. And they provide hospitality and entertainment to many of our visitors. Small business owners in Massachusetts and throughout the country are certainly the backbone and strength of the American economy. As we tackle tax reform, it's critical that we implement tax policy that helps America's small business grow and prosper. It's through that prism that I think we should review Chairman Camp's proposals today. I also commend Chairman Camp for including so many proposals in his bill that are bipartisan. His draft would make permanent increases in expensing for small businesses, a proposal that has received much bipartisan support over the years. He's also included proposals based on legislation introduced by our colleagues Ron Kine and Jim Kerlock, Mike Thompson, and Aaron Schock. I think this once again demonstrates that there are opportunities for common ground in our approaches to tax policy, and that we can and should do tax reform on a bipartisan basis. So thank you for calling the hearing, Mr. Chairman, and I'm going to excuse myself for a brief period of time only to testify in front of Chairman Chris Smith's committee on an issue that I have long been involved in this morning. So I'll just be gone for a brief period of time and back, and with that said, I yield back my time.
Thank you, Mr. Neal, and we thank you for your leadership on this issue. Now I'd like to turn to the panel and welcome the four individuals who are here today. I'll introduce the four, and then we'll begin the testimony with Mr. Harris, who I'll introduce first. Mr. Roger Harris, President of Paget Business Services in Athens, Georgia. Thank you for being here, sir. Second, Mr. Willow Taylor, former partner at Sullivan and Cromwell and currently a professor of law at New York University. Thank you for being here. Third, Mr. Blake Rubin, a partner at McDermott, Will, and Emery here in Washington, D.C. Thank you, sir. And fourth, Mr. Tom Nichols, a shareholder at Mesner, Tierney, Fisher, and Nichols in Milwaukee, Wisconsin. Thank you for being here, sir. With that, you'll each have 5 minutes to present your oral testimony. Your full written testimony has been submitted for the record. And Mr. Harris, you're recognized for 5 minutes.
Thank you, Mr. Chairman, and thanks to the members of the committee for the opportunity to be here today. I am Roger Harris. I am President and Chief Operating Officer of Paget Business Services. And I think to help understand my comments, it's good to understand what we as a company do and who we define as our small business customer. Paget Business Services has provided accounting, income tax preparation, tax advice, payroll services to small businesses for almost 50 years throughout the United States through our network of offices. We have always defined our customer as a small business owner with fewer than 20 employees. And a lot of people look at those businesses individually and say they are mom and pop businesses. However, if you look at them as a group, they are a tremendously powerful force in this economy, and I think we need to make sure that their needs and their interests are addressed in any tax reform discussion. And I think it would be very difficult to find anybody in this room or this town or this country who doesn't think the tax code that we currently have has seen its better days and needs to be replaced. I can tell you that our small business owners particularly want to find something new that they can work with. They want something that's simple. They want something that has some predictability to it. They would like something that encourages or increases their cash flow. And more importantly, they want something that mirrors their checkbook to some extent. They're tired of having to be explained what's the difference in their cash flow and their taxable income. So they want something that mirrors their checkbook as close as possible. I'm happy to say that the draft proposal that the committee put out a few weeks ago, I think, works towards these goals and is a great starting point for these people. Particularly beginning with the 179, if you look at the proposals for it to make permanent the $250,000 deduction limit and the $800,000 phase out, permanent in the sense that it's indexed. For our clients, those limits are very sufficient and would work wonderfully well and would eliminate a lot of record keeping of tracking assets because it would cover most of their purchases. I recognize, however, that for some industries, particularly heavy equipment industries, those values or those numbers may not be enough. But for our businesses, those values are great. And they also, because they have the ability to write them off currently and not have to track them, it mirrors cash accounting, which is the second part of the proposal that we're particularly pleased with, is that this proposal will expand the number of businesses who qualify for cash accounting. Again, getting down to the basic principle of a small business owner, when money comes in, it's income. When money goes out, it's an expense. And what's left is their income. Because if there's anything they hate more than paying taxes, it's having to pay taxes with money they don't have. So the closer that we can mirror their checkbook, this proposal goes a long way to do that. We would like to see it perhaps go a little bit farther, and I'm sure we can talk about it more, but I think carving out something like a safe harbor for the smallest businesses in this category to be able to ignore the tracking of inventory. I think at times we think inventory is nothing but looking on a shelf and making calculations of how many of what sits on a shelf. And it's much more complicated than that, and I think we should be able to come up with a carve-out again for these small businesses that allows inventory reporting to be at their option if they're at the smallest end. The next part of the proposal talks about startup and organizational expenses, and it doubles the number from 5 to 10,000, which again for many of our clients will be sufficient and will have the impact of, in essence, making it cash accounting. However, here again, I would like to see for, again, the smallest of small businesses, more leniency in that area, in that when you start a business, in the year that you start your business, all your expenses or startup should be deductible. From a personal standpoint, it's very hard to tell a small business owner that the expenses that you paid in July are fully deductible, but that exact same expense that you paid in February when you were trying to get your doors open may or may not be deductible. To them, it was the same check to the same purveyor, and they believe it should be deductible. Finally, I'll put on my practitioner hat and address the filing dates for these business returns. I want to commend the recommendation of moving the partnership date back to March the 15th to create that 30-day window to still have the individual return prepared. I think that's long overdue. That used to be the date for the S-Corp return. This proposal moves it up to March 31st. I would like to see it stay at March 15th and have a unified date for pass-throughs, so we all know that all pass-throughs are due the same day and we all have the same 30-day window to get to the individual return. I'm not sure a partner or shareholder see themselves any different. With that, my time is about up. I want to thank the committee again for the opportunity to be here today, and I look forward to your questions.
Thank you, Mr. Harris. Mr. Taylor, you're recognized for 5 minutes. Mr. Taylor, can you turn on the... That's all right. Perfect.
Okay, good. Thank you. I'm an adjunct professor at New York University Law School, and I also teach at the Yale and the University of San Diego Law Schools, in each case a course on the federal income taxation of business pass-through, so it's a pleasure to be here to talk. The committee discussion draft has two basic structural reforms. One is specific changes to Subchapter S and Subchapter K, that's option one, and the other is a more fundamental revision resulting in a single system of tax rules for all pass-through entities, whether incorporated or not. I think what's proposed in option one is basically good. Many of the proposals have been around for a long time. I think you could add some to them. I think you could also expand them. But they're all basically good. However, they're really just improvements, if you will, to the system and not fundamental tax reform. So I think the focus ought to be on option two, the single pass-through regime. And I think that the most compelling argument for that is that there really is no difference apart from tax between a limited liability company and a corporation. One's incorporated, the other is not. But the choice between the two has huge tax implications, including the treatment of foreign and tax-exempt investors, the different treatment for payroll tax purposes, and we could go on and on about it. Subchapter S came in 1958 at a time when it was necessary to give limited liability to small businesses. That's not necessary today. You can form a limited liability company and not incorporate and get the same advantages. Now, option two then offers the opportunity to address those differences. It also offers the opportunity for small businesses trapped in Subchapter C to move into Subchapter S, and it also provides a simplified regime. There's a huge amount of work that has to be done if option two is going to be implemented, and the draft notes a lot of that. And I won't go over it, but I want to mention four items that I think in particular should be focused on. One is achieving parity among investors. There really should be no difference in the treatment of a foreign investor in a partnership and a foreign investor in a privately held corporation. And if you don't straighten that out, you distort investment decisions and capital raising. And the same is true with respect to tax-exempt investors. You should have a single set of rules. Now, on tax-exempt investors, inevitably you're going to hear from ESOPs who love S corporations as to why they shouldn't get that treatment continued, both for S corporations or if you have a single regime for Subchapter K. That's a different issue, but I don't think you ought to neglect it. Another second issue that deserves attention is payroll tax. If you've got a single regime for federal income tax purposes, no difference between a partnership and an S corporation and a small privately held corporation, then why in the world would you have a difference in payroll taxes? But you do today because the base for SECA, the self-employment tax, differs from the base for FICA. So you would have to address how do we resolve that? How do we come to grips with it? The third issue is determinations of tax liability, and do you do that at the entity level with a withholding tax, as has been proposed in the draft, or do you let each owner make his or her own determination? I personally think doing it at the entity level makes sense. But again, it's an issue that has to be come to grips with. The fourth and final issue I would mention is foreign income. If you have a 95% dividends received deduction and a lower rate on dividends from a C corporation, you're going to have to compare the effective tax rate for the pass-through entities, which may be higher if you don't do something about it. So I will end there. I've sent in longer written comments. I agree with Chairman Tiberi that this is a hugely important subject, and that's the last word I'll say on the subject. Thank you.
Thank you, Mr. Taylor. Mr. Rubin, you're recognized for 5 minutes.
Thank you. Chairman Tiberi, Ranking Member Neal, and distinguished members of the subcommittee, thank you for the opportunity to testify today. My name is Blake Rubin, and I'm Global Vice Chair of the U.S. and International Tax Practice at McDermott, Will & Emery, a law firm of approximately 1,100 lawyers. I support the effort to reform the Internal Revenue Code and also applaud the committee for the robust and transparent process that it is following. I also congratulate the committee leadership and staff for producing a detailed and thoughtful set of options. I'll focus my comments primarily on the proposed changes to the taxation of partnerships. I support most of the changes in Option 1. As detailed in my written statement, however, I believe that 3 of the changes in Option 1 are unwarranted. Eliminating the 7-year period for application of the so-called partnership anti-mixing bowl rules, making upward basis adjustments in the context of partnership interest transfers and distributions mandatory, and eliminating the substantial appreciation requirement in the partnership hot asset rules. Option 2 proposes much more sweeping changes, merging the current tax regimes for partnerships and S corporations. This is an approach that has been proposed by some academic commentators, primarily for reasons of simplicity. There is no denying the conceptual appeal of a single unified regime for pass-through entities. If one were designing a tax system from scratch, rather than reforming a tax system that is now 100 years old, a single unified regime might well be the way to go. Given where we are today, however, I believe that Option 2 would significantly increase complexity, upset settled expectations of taxpayers, and cause substantial economic dislocations. Current law provides taxpayers with a choice. Businesses that want a relatively simple pass-through regime and can tolerate a certain amount of inflexibility can operate as S corporations. Other businesses need greater flexibility, perhaps because debt is a bigger part of their capital structure, or because they anticipate the need to distribute property in kind, or they want a more complicated economic sharing arrangement. For those businesses, the partnership tax rules provide the needed flexibility to operate without incurring an entity-level tax, but at the cost of greater complexity and compliance burdens. Option 2 would eliminate this choice. Worse, it would do so by creating a single unified regime that effectively combines the complexity of the current partnership regime with the inflexibility of the current S-corporation regime. Many of the provisions of the current partnership tax regime that create the greatest complexity are retained and even expanded in Option 2. At the same time, Option 2 imports inflexibility from the S-corporation regime by restricting the ability to effectuate complex economic sharing arrangements and triggering gain on distributions of property in kind, even though the taxpayer receives no cash. I'd like to briefly address 2 of the most significant changes proposed by Option 2. The first is the 3-basket rule, under which an owner is restricted to a single percentage share of all items in each of 3 baskets: ordinary income items, capital gain items, and tax credits. The summary states that the reason for this rule is to reduce the use of complex structures to engage in tax avoidance. I believe that the existing regulations governing allocations of partnership income and loss adequately police this area. I also believe that this change would create unwarranted restrictions on the ability of taxpayers to effectuate non-abusive commercial arrangements. For example, as detailed in my written statement, it's not clear that one pass-through owner could have a common interest akin to common stock and another a preferred interest akin to preferred stock because of the requirement that items of profit and loss in each basket be allocated in the same percentage. The second change I'd like to focus specifically on is the recognition of gain on the distribution of appreciated property. This is, of course, the current rule in the context of corporations, including S corporations, but extending that rule to partnerships would undeniably result in the taxation of non-economic gains in many cases. To take an example, assume a partner has a 50% interest in a partnership that has property with a $200 value and a 0 tax basis. The partner's interest is worth $100 and has a 0 tax basis. The partnership distributes property worth $50, also with a 0 tax basis, to the partner in redemption of his interest. Under Option 2, the partnership recognizes $50 of gain on the distribution, and the distributee partner recognizes an additional $25 of gain on the distribution. So a distribution of property with a 0 tax basis and $50 of value triggers not $50 of gain, but instead $75 of taxable gain. In this and many other common transactions, Option 2 would create taxable gain that exceeds actual economic gain. I thank you again for the opportunity to present my views today and commend the committee leadership and staff for advancing the debate in this area. Look forward to answering your questions now and in the future.
Thank you, Mr. Rubin. Mr. Nichols is recognized for 5 minutes.
Chairman Demiri, Ranking Member Neal, and other members, thank you very much for the opportunity to testify today. I've been representing closely held businesses Ever since I began practicing tax in business law in 1979, I have been a member since 1986 and am a past chair of the ABA Tax Section's Committee on S Corporations and am currently chairman of the Board of Advisors of the S Corporation Association. The views expressed today are informed by and benefit from all of these relationships. I will focus my comments primarily, though, on S corporations. Let me begin by saying that I sincerely appreciate your ongoing bipartisan efforts to enact genuine tax reform. Seeking public comment on discussion drafts takes substantially more time and effort, but this more open and transparent process is much more likely to result in a long-lasting consensus on tax policy that will truly benefit our economy. Chairman Camp has identified several fundamental principles to help shape the course of tax reform, namely leveling the playing field for all U.S. employers, while at the same time ensuring that low-income and middle-income Americans pay no more in taxes than they do today. In this regard, the Bipartisan Tax Reform Act of 1986 stands out as an excellent template. It expanded the tax base by eliminating numerous preferences and privileges, thereby creating room to dramatically decrease tax rates and for C corporations, pass-through businesses, and individuals alike. As others have noted, the discussion draft before us today has three principal components: a more limited option 1 to address limitations of the existing S corporation and partnership rules, a more aggressive option 2 that would replace the existing S corporation and partnership rules with a new uniform set of rules, and finally a set of core provisions that would apply to either option. I'll begin with the core provisions and work from there. Generally speaking, the core provisions, such as establishing a higher permanent threshold for expensing equipment, are reforms that have been considered and vetted for years and should be included in any tax reform effort. One core provision that might not fit that description is the proposed mandatory use of accrual method for businesses with gross receipts of more than $10 million. S corporations and partnerships that don't have C corporation partners are currently entitled to use cash basis accounting. This makes sense because closely held businesses do not have access to the public markets to monetize illiquid assets on their balance sheets, so requiring them to pay tax on income they have not yet collected could create cash flow challenges where none exist today. For S corporations, option 1 includes many provisions contained in the bipartisan S Corporation Modernization Act introduced by Congressman Reichert and Kind, which are consistent with the goals of tax reform stated above. The discussion draft would make permanent the shorter 5-year built-in gains tax recognition period. The built-in gains tax was initially intended to prevent C corporations from electing S status simply to avoid double tax in connection with the sale of the business. But a 10-year period is much longer than necessary. 5 years is much more appropriate. Other positive provisions in option 1 relate to the passive investment income tax, electing small business trusts, and charitable contributions. From the S corporation perspective, option 2 would establish a better line of demarcation between pass-through businesses and those subject to the corporate tax, namely whether a business has chosen to access the capital markets and public ownership, and would bring this demarcation in line with the corresponding cutoff for partnerships. Updating the current limitations on types of shareholders eligible for S corporation ownership as contemplated by option 2 also makes real sense. My basic concern with option 2 is that it would take two significantly different business structures: the simple and easily administered S corporation structure and the more flexible but also more complicated partnership rules, and attempts to meld them under a single unified regime. The details of option 2 are well thought out, but I am concerned that the benefit of a single unified regime may not be worth the cost. Option 2 would add additional complexity to existing partnership rules and then apply them to S corporations. This means imposing new rules and compliance burdens on the more than 4.5 million S corporations in existence today. As for new entities, S corporation status is the most popular tax entity choice today. Thus, eliminating this structure could impede business formation. A better approach might be to take the positive reforms included in option 2 and combine them with the more modest ambitions of option 1. Once again, I'd like to thank Chairman Tiberi and Ranking Member for inviting me to testify. I look forward to questions.
Well, thank all of you. on behalf of the committee and the committee staff for being here today, for your written testimony, which I said would be part of the record. I don't know about you, but I was excited that you were going to be here and that we were having this hearing today. Unfortunately, most of Washington, including the press corps, I think is more excited about the hearing in 48 hours in this room. But this is pretty important, and this is going to be part of the process, the transparent process that Sharon Camp has had. And so your testimony is very, very helpful. Mr. Nichols, I'm going to start my questioning with you. As you know, for the last 12 years, S-corps and pass-through entities have had a statutory top rate of 35%. In January, that changed, and we saw the top rate rise to 39.6%, but with the addition of the 3.8% tax from Obamacare on investment income, the PEAS limitation, which adds another 1.2%, you have a reality of a tax rate much higher than that. But something that I didn't realize until recently that I'd like you to comment on is that 3.8% tax on an investment income that I didn't realize actually falls on something much broader than investment income. So if I were selling, my understanding, if I were making widgets and then selling widgets, that 3.8% investment tax would fall on the making and selling of those widgets as well. So in essence, this means that the top rate on an S-corp manufacturer in my home state of Ohio is now 44.6% and not 35%. So a pretty large tax increase that's not just investment income. Can you expand upon that and expand upon how much broader this 3.8% tax is than many of us thought or think?
Yes, I'd be happy to. Essentially, what happens is there are two things at play here. One is if you've got any passive investors in the S corporation itself, then that passive investor is going to require distribution of money to pay taxes that based on the top rate, so that you've got the 39.6% rate, you add on to that the PEAS reduction, another 1.2%, then you add on the 3.8% tax. You get up to approximately 45%, as you point out. And essentially what happens for S corporations is that if you've got, let's say, a 10% shareholder, let's say a father who's no longer involved in the business, that ends up paying that tax, most S corporations have an obligation under shareholder agreements to distribute out an amount to pay the tax attributable to pass-through income. The combination of having one shareholder subject to that tax, that 45% tax rate, and the fact that the S corporation rules require a single class of stock means that if you're going to distribute out 45% to one of the shareholders, you're going to have to distribute out 45% of the income to all of the shareholders, even though some of them may not have to pay that additional tax. All of that will have to come out of the corporation and won't be available, obviously, for future use inside the corp.
Thank you. So, as you know, the 86 Act reduced the top rate from 50 to 28%. And now we see the rate essentially going up to almost 45%. Not quite 50, but 45. So, over the last 27 years, we now have, since 1986, the highest rate, statutory rate, for S-corps and pass-through entities, correct?
That's correct.
And what do you see as as a practitioner, what do you see the reaction to that on the ground?
Well, realistically, very many, in fact, I would venture to say most closely held businesses, they essentially earn their income. If they're pass-through businesses, they reserve to pay for the tax, and then the vast majority of what's earned is essentially rolled back into the business. Essentially what happens if the tax rate goes up, and essentially it's gone up now potentially at a 10%, by a 10% increment from 35% to 45%, and that's without taking state taxes into account. Essentially that 10% used to stay inside the company and used to be reserved and used, either reserved for capital or used to actually grow the business, hire people, do whatever the business needs. That 10% is effectively just an additional slice out of the capital that would otherwise be used in the business for most of them.
One last question, because I've taken almost all my time, is a fascinating point you made in your written testimony, that a clear, trying to get this right, a clear demarcation between who may be an S Corp and who may be a C Corp is whether they are publicly traded, which is kind of a line of demarcation that is proposed in option 2 for new pass-through entities. Can you elaborate on why you think publicly traded, privately owned line is conceptually a correct way to distinguish between the two?
Well, it's a difference. It's a distinction that makes a difference, unlike the fairly arbitrary 100-person limit that currently exists. It's a distinction that makes a difference. There are a number of things that are different about a publicly held entity. They're treated differently, and essentially what the point I made in the written testimony is that essentially if I'm selling a closely held company, a privately held company, I'm likely to get multiples, let's say, maybe in the neighborhood of 5, maybe 12 times earnings if you're lucky. Whereas publicly traded companies regularly trade at 10 to 20 times earnings. So that's a big difference, and it's something, frankly, I have to explain to some of my closely held clients, that there's a difference being closely held. And so as a consequence, that, and the other thing that is significant for closely held clients, and that is they don't have the opportunity to turn around and go to the public markets. They don't have that automatic price that they can sell stock for, and it's not easy for them to go to the public markets to borrow money either for publicly held securities. And so as a consequence, that demarcation line is one that does have some policy significance, and to the extent possible, the demarcation lines in the code should reflect, significant differences between the business entities, and that one does.
Thank you. Mr. Neal is recognized for 5 minutes.
Thank you for your indulgence earlier today, Mr. Chairman, as well. And Mr. Nichols, you can help to explain some of these things to us, so it would be helpful. Mr. Rubin, could you describe for me the tax consequences for both partners involved and the partnerships of a merger of two partnerships, each of which contains appreciated property under current law? And can you describe the tax consequences for both partners involved and the partnerships under option 2 of Chairman Camp's draft? Any potential administrative burden of the merger under option 2 is relative to current law.
Sure.
This is very helpful, incidentally, to us. Very, very helpful.
Great. Under current law, if two partnerships want to merge, first under state law and the Uniform Limited Partnership Act, the General Partnership Act, the LLC Act, that can be accomplished by filing articles of merger. So relatively convenient way to combine two companies operating in partnership form. From a tax perspective, let's say you've got the AB partnership merging with the CD partnership. For tax purposes, that's generally treated under current law when they file articles of merger as if the AB partnership contributed its assets into the CD partnership in exchange for an interest in the CD partnership, and then the AB partnership liquidated and distributed the interest in the CD partnership out to the partners. What's important about that is that under current law, all of those deemed transactions are generally tax-free. The transfer of the assets into the combined entity, if you will, that's deemed to occur, and then the transfer of the interest in the combined entity that goes out. Under option 2, that would no longer be the case, because when the AB partnership that's going out of existence is deemed to distribute the interests in the CD partnership out to its partners, that's a distribution of appreciated property. It would trigger gain both at the AB partnership level and then potentially a second gain at the AB partner level. So what can be consummated tax-free under a carryover basis regime so that the built-in gain is taxed in the future on a disposition to a taxable disposition to a third party is taxed immediately under option 2.
In Massachusetts, 92% of the firms are structured as pass-through entities, and there are nearly 90,000 businesses structured as S corporations. The level of choice is pretty unique to the United States. Mr. Nichols, in your testimony, you've indicated that there are benefits to offering entrepreneurs multiple options when choosing a business structure. On the other hand, option 2 in Chairman Camp's draft proposes moving most S corporations and partnerships into a single uniform structure. Could you go into a little bit more detail on what you see as the benefits of sticking with the current set of options of business entities, as well as the potential costs of moving all of these businesses to a single new entity?
I'd be happy to. Well, currently you have approximately 4.5 million S corporations. It's the most popular format. It's the most popular tax structure for closely held businesses. You've got about 3 million, well, a little more than 3 million partnerships also. So, but what you've got, the S corporation structure has the advantage of being simple and being easy to administer. And that's something for many, many corporations. They're not interested in sophisticated and flexible capital raising mechanisms. All they want to do is make widgets. And when given a choice to simply have a simple structure, not do any sophisticated transactions, but just focus on their business, they like that. The partnership structure is much more flexible, and as a consequence, it's much more complicated. And some of that complication is imposed by Congress in order to essentially rein in the flexibility so that abusive transactions don't occur. What happens in option 2 potentially is the partnership rules are made somewhat more complicated and more restrictive, and all of the S corporations that currently exist today essentially are being forced into that structure. And what happens then, you've got an unavoidable cost for a lot of just day-to-day businesses that have been S corporations for many times, many years. They're forced into that new structure. They need to deal with both the transition, but they also need to deal with the ongoing complexity of the partnership rules. For example, under the proposal and even under the current law, there are changes and adjustments that potentially need to be made whenever there's a sale of any interest in the business, even a minority interest. There's also the need to bifurcate transactions for distributions and for on sales to determine whether hot assets are applicable and treating that as a separate transaction. All of that complexity, it may be appropriate in the partnership regime, which is much more flexible. On the other hand, it has not been found necessary in the S corporation regime, but you would be essentially requiring all of the current 4.5 million S corporations to switch to that more complicated regime and the compliance costs, but also there'd be ongoing compliance costs. And what I don't see is a countervailing economic benefit. I don't see any S corporations engaging in more economic activity as a consequence. And so as a consequence, I see a cost, but I don't see the benefit of that forced conversion.
Thank you, Mr. Chairman.
Thank you. Mr. Young is recognized for 5 minutes.
Thank you, Mr. Chairman. I appreciate you and Ranking Member Neal for holding this hearing. Very important to all of my colleagues, really to the country. Each of us has a plenitude of pass-through entities in our districts. There's one, I'd like to begin just with a remark. Respectfully reminding my colleagues and those who are paying attention that we need to be attentive to one type of pass-through entity that has not been addressed yet, at least not in a specific way in some of the discussion drafts, and that's ESOPs, the employee stock ownership entities. And I do believe there will be consideration of this as we move forward, but I think we should strive to avoid any inadvertent damage we might do, as Mr. Taylor indicated, to these entities, seeing as they empower employee ownership. And per my briefing, they're 4 times less likely during a recession to lay off employees. So that's something for us to consider. My first question relates to withholding. Here we go.
One, two. Why don't you try another microphone? This one works. George, you want to take a seat? George, you want to sit down too?
Here we go. I'm Mr. Young. Thanks. As we say in the Marine Corps, adapt, improvise, and overcome. So here we go. My question relates to withholding. Mr. Nichols, you touched on this briefly in your testimony, and I believe each of you are aware that in option 2 of the discussion draft, we suggest an entity-level withholding rather than our current practice. Now, as practitioners that deal with small businesses every day, can you talk a little, either Mr. Nichols, perhaps others have thoughts, about the negative impacts as well as the positive outcomes that this change might create? Specifically, I'm interested in how the provision might impact cash flow, whether it might create cash flow problems for any type of existing pass-through entity.
Yes, there are a number of considerations here. Obviously, one is compliance, and the withholding system that is proposed is not a completely new item. There are a lot of S corporations that have out-of-state operations. They actually have a withholding system that they need to deal with in order to withhold taxes for their out-of-state operations in the various states that they're operative in. Now, the withholding system at the federal level potentially creates more of a cash flow situation. The amounts for the state systems are typically smaller. And the other thing that would need to be factored in, and I'm not sure the proposal contemplates it, or I'm not sure it does, I'm not sure it doesn't. But the other thing that would need to be factored in is the fact that tax rates at the corporate level, if they are to be uniform, are unavoidably going to impact cash flow. And I can give you two examples. One example would be if the taxpayers are in a lower tax bracket and you've got a mandated withholding rate that is above that tax bracket, obviously there's going to be an amount that's going to need to be withheld, and then the taxpayers are going to have to wait till next year to get that refunded to them. It's like any other withholding. You don't get it until you file the return at the end of the year. The second one that I think is potentially more problematic, but maybe it could be dealt with, and that is the idea that you've got a taxpayer that runs or has interest in two different businesses, and they've got $100,000 of income in one business and $100,000 of loss in the other business, but they're in two separate entities. Under the withholding regime, unless you can take into account the individual taxpayer's facts, you would end up having to have withholding occur on the $100,000 from the profitable business, notwithstanding the fact that that shareholder, that owner, is doing exactly what we hope they do in today's economy, use those profits in another business, hire people, and use that. Well, you can't do that if some of those monies are siphoned off in the form of the withholding, and you're not going to get them back until after the end of the year.
Any other quick thoughts here? We have about 30 seconds left.
Yeah, I think you're missing something in this whole picture. You could take the withholding tax and put it in option 1 and apply it to S corporations and partnerships. The merit of option 2 is not the particular features, all of which could go in option 1. The merit is it gets you to focus on the difference between the entities. I mean, take your ESOP point.
Yeah.
You can have an ESOP as a shareholder of an S corporation today, okay? You cannot have an ESOP partner in a partnership and get the same tax consequences. Your point about the net investment income tax, if you're an S corporation, you can eliminate a large part of that 3.8% tax on your S corporation earnings, assuming it's not a passive activity. You cannot do that generally if you've got a partnership. So the point here of option 2 and option 1, I think, is option 2 forces you to ask the question, why is this different from the way it is here? Right. And that's what you should be focusing on, I think, not the particular features, all of which, as I say, you could put in option 1 if you wanted.
Thanks so much. I yield back. And if you have further testimony, maybe you can submit it for the record.
Does someone else have a thought? Go ahead, Mr. Harris. I feel generous.
Thank you.
Thanks.
Mr. Chairman.
I think one thing, in addition to what's been said, when you get to entity level withholding, we have to consider the complexity on the small business owner of understanding what are we going to withhold on, and what records are they going to have to keep, and what efforts are they going to have to go through to calculate the number that we're going to withhold on. So I think we have to be very cognizant of the fact that we could be adding complexity that may or may not benefit anyone for the other problems here, that we could be a wrong amount, it could be offset somewhere else, and yet we've imposed burden. So I think we should always look, if we're going to look at entity level withholding on something that's easy to get to, perhaps like payments that are made to shareholders and partners as opposed to a calculated income amount.
Thank you.
Let me just tell you, I can tell the difference between someone who's trying to filibuster an answer and someone who's trying to be substantively helpful. And I think the four of you, your testimony, both written and your testimony today, is great, very helpful, very interesting, and so help us by being substantive in your answers, and don't feel pressure on the clock. Not everyone will always tell you that. Mr. Gerlach, recognized for 5 minutes.
Thank you, Mr. Chairman, and gentlemen, thank you for testifying today. Mr. Harris, and I'd like to get the other three gentlemen's thoughts on this as well, but I want to base my question on your testimony, and in particular your written testimony, on the issue of the startup and organizational expense provisions that would increase the amount as a startup company you could deduct under the code. And you approve of that proposed draft language, although you go on to say that you would suggest an even more aggressive approach to startup expenses for small business owners that qualify for the use of cash accounting. Can you expand a little bit more, if you would, on your thoughts on how the current discussion draft language could be improved upon relative to that particular expensing that we'd like to see startups be able to have, so that encourages them to move forward with that initial business activity?
Sure, I'd be happy to, because I think one thing we can all agree upon, we want more businesses starting up, and
right.
Anything that we can do to encourage that is going to benefit us all. Mine is more of really expanding the cash accounting rules to say, when you start a business, in the year that you actually open your doors, I believe we should allow them to deduct any expenses they incurred through that process. Again, if it started in a prior year and it rolled into a current year, that would be carried forward. But as I said in my opening statement, it's very hard to explain to a small business owner that the expense you pay in July, you can fully deduct, but the exact same expense that you paid in February, because it happened to come prior to the opening of your doors, may not be deductible or has to be capitalized depending on the amount. And it really comes down to, again, the basic understanding. As I've heard a lot of discussions today, I think of it in terms of our clients and our small business owners, and they're sitting there going, this is what's wrong with the tax system. You know, if I paid the money and I started the business, why isn't it a deduction?
So if you start the business November 1st, but of course leading up to opening those doors on November the 1st, in February, March, and April, you're incurring different organizational and other expenses that are justifiable for the startup of that entity on November 1st. All of that should be deductible for that tax year is what you're suggesting.
Right, because all that money is gone, and they have expended the funds.
And it's out of the checkbook, which is the basis for which they make decisions.
Yes.
Yeah. Gentlemen, the other folks in the panel, do you have a thought on that same issue?
Well, I certainly agree. I would just add to that, and that essentially what you've got is the dichotomy between the accounting principles and the tax principles. And there are a number of provisions in the code, and over the course of its history, for example, for accounting purposes, you capitalize those startup costs because you want to communicate to your outside investors that it's not all wasted money. It's over time it's going to build up, and you're going to have something of value. And it makes the first year not look as bad as it otherwise would. And so you've got the accounting principles that go in one direction, but you've also got the tax principles that essentially say, from the standpoint of tax policy, is this really a time in which we want to allow somebody, put somebody in a position of paying expenses and not give them the deduction? And when you look at it from the standpoint of tax policy...
Because the whole goal is that you want them to be successful.
Exactly.
And it's from a cash flow standpoint that they will or won't be successful.
Exactly.
Is that okay? Great. Mr. Taylor, Mr. Rubin, do you have a thought on that? Okay. No comment. Good. Well, thank you very much. Appreciate that. I yield back. Thank you, Mr. Chairman.
Thank you, Mr. Gerlach. Mr. Larson, you're recognized for 5 minutes.
Thank you, Mr. Chairman, and I want to thank our panelists as well for being here today, and again want to thank Chairman Camp for putting out his proposal, and obviously in the case of small businesses, especially the notion of simplicity is something that we all want to strive for. And looking at the two options that are before you, and I'd be interested in your responses, in real terms, real life, anecdotal or otherwise, what does simplicity mean to you, and what could we best do to assist small business in the tax code? Is it, as my colleague often suggests, not having to have a accountant 12 months of a year, but only that 1 month when you actually need them? Is it the less reporting? What is it in the overall simplification that we could do to make you more entrepreneurial, as Mr. Harris said, and to grow businesses and encourage people to get involved? And we'll start with Mr. Harris.
I think from the perspective of our clients, what simplicity means to them is that to the extent that it is possible, that the tax system can follow the records that they have to keep to run their business, that they aren't being forced to keep records solely to comply with the tax law, that the basic records that we all need to keep to run our business should be sufficient for filing taxes. It shouldn't require a lot of complexity. And it should also, I think, allow them to operate in a real world. As I was listening to the example of partner A and B merging with partner C and D and all that, in the real world, those are just four guys that came together to start a business, and yet if they heard this discussion, their head would explode. Because they're saying, what do you mean? I mean, we were just decided to work together. So I think what we have to do is we try to mirror the records they keep and recognize what they're doing every day to run a business and try to make that our tax law as best we can.
Thank you, Mr. Chairman. Taylor?
Let me just add one thing, without disagreeing in any way with what you said. It seems to me...
Could you speak into the mic?
Yeah, I'm sorry. Oh, thank you. It seems to me great simplicity would be that you did not need to come and talk to us before deciding whether you were going to be a partnership or an S corporation. And that's the merit of option 2. There's only one system. Now, we can disagree as to what the features of that system should be, and I think there is disagreement. But, not having your fundamental choice being something that's dictated can only be sensibly made from a tax point of view if you have an accountant or a lawyer. That is crazy. And the difference is between limited partnerships, limited liability companies and S corporations from a tax point of view are huge and pervasive. And so if you could get to a single regime where you didn't need that accountant or lawyer up front, that would be simplicity, I think.
And I guess I would argue that that's only conceptual simplicity rather than practical simplicity, that under current law, the regime really provides a choice, that people who want greater simplicity and less flexibility can achieve that through an S corporation. People who need greater flexibility to distribute properties, need to have debt included in basis and so forth, they can deal with the more complicated rules. And, again, in concept, combining them means you don't have a choice, and maybe that's simple in a way, but I think as a practical matter, it means that a lot of people who currently are happy with the S-Corp regime have to deal with a much more complicated set of rules.
And actually, I would agree with Mr. Rubin. I guess if you look at this from the standpoint of the small business owner, watch what they do, what they want to do, and what they have done. And 4.5 million of them, the plurality of them, have chosen to be S corporations. Don't disrupt what they're doing unless there's good reason to do so. And moving that, changing, and one of the things that does keep lawyers and accountants busy and employed is changes. And if you've got a system that seems to be working and seems to satisfy the needs of both the revenue needs and the needs and of the individual businesses, and they've grown accustomed to it. Don't change that without, solid underpinning of reasons to do so, just because the disruption alone slows business down.
Thank you.
Thank you. Mr. Schock is recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you to the witnesses. A couple quick follow-up questions. One on cash accounting. I'm pleased that the chairman included the framework of Mr. Thompson in my bill that increased the threshold from $5 million to $10 million permanently. However, I'm aware of specific groups in my district who were exempted from current law that allow for unlimited amounts to be used on cash accounting, particularly in the ag industry. I've got some large pork producers that currently are allowed to use cash accounting. So I'm wondering, from your perspectives, if you're aware of other folks who may be exempted currently that will not be exempted under the chairman's proposal, and if you could talk a little bit about what effect this will have on perhaps accountants or others in the service sector, or a large pork producer like the ones in my district that have to go from an accrual basis to a cash basis if in fact there are no exemptions for folks over $10 million. Mr. Nichols?
I mean, so people being forced to essentially go from a cash basis to an accrual basis.
Correct. I'm sorry, yes.
Well, one of the big exemptions that currently exists in that is closely held S corporations are exempt currently, and this essentially would eliminate that exemption for all S corporations below the $10 million level. And so as and that, I think, any time you vary from the cash being in the door to pay the tax, and you're requiring tax to be paid, perhaps before in this case, before it's collected, you should take into account that you are creating a cash flow situation that is potentially problematic. Under the current rules, there are a number of corporations, S corporations and partnerships that don't have C corporations as partners, that are eligible for the cash basis method of accounting. This would eliminate that. It would essentially create another one of these demarcation lines that is somewhat arbitrary, unavoidably. If it's 10 million, if they move $1 million above 10 million for 3 years in a row, then suddenly they're on a completely different system. And there I would focus on, is there a policy reason that's important enough to require enterprises that haven't collected the cash right away, they haven't collected the cash already, is there a policy reason important enough to require them to pay the tax on that income that they haven't received yet? And that's, if it's not broken, don't fix it. Be careful if you change things so as not to disrupt the business.
Mr. Harris?
Just to add to that, I think we have to understand that the only real difference between cash and accounting is when the income shows up, not if it shows up. So to his point, what is the incentive to require the perhaps accelerated reporting of the income? What is the benefit of doing that as opposed to waiting until it actually shows up? Because it will eventually show up and be income when the money is paid. So unless there's a real policy reason, as he said, to force that acceleration into income, I don't know why we don't just wait until they actually have it.
Okay. Well, it might have something to do with the CBO score. Second question really is just genuinely interested in your view on this effect on small businesses. A lot of times we focus on the big C Corp guys. Got a few of those important ones in my district, but we also recognize that the majority of Americans work for small companies, and it's the startups really who are the engine of our economy. And some of the things we do, like 179, raising that threshold to 250, making that permanent. Is there anything else you guys are aware of that maybe we aren't doing that we should be doing, or perhaps we should look at, particularly for small startup companies? You think about the Apples, the Microsofts. They started in garages. They didn't have your traditional framework. You're not going to use R&D incentives for a small startup like that. Are there other things that we could be looking at for some of those organic startups?
I think we've discussed a lot of the things that we should do. Again, when you're starting up at the smallest of small businesses, cash flow is just of critical importance. They don't have access to capital. They're probably doing it from maybe even credit cards or living on a spouse's salary. So we should do everything we can to allow them to keep as much of their cash as they can and not get into complicated broadening base exercises, if you will, which is basically saying something you've spent can't be reported yet, can't be deducted yet, is to allow them to keep the money in their startup years when it's the most critical, because if they can get through those 1 or 2 startup years, they tend to have a chance to survive. So we should be very careful to do everything we can in a startup mode to allow their tax return to mirror their cash flow as closely as possible, because cash is at a premium at that point.
Mm-hmm. Anyone else? Mr. Nichols?
Well, I'm finding myself agreeing with Mr. Harris more and more. But essentially, and to a great extent, what I'm going to do is repeat what he just said. But essentially, there are 2 ways. One is by recognizing income only when it's collected, and the other one is by giving the benefit of deductions to startup businesses when they actually pay it, as opposed to over time. And both of those, frankly, help small business, especially startups who are cash starved.
And what's proposed in the rough draft you feel is sufficient?
It's an improvement. I don't disagree with Mr. Harris that the idea of allowing startups to actually expense, at least maybe up to a cap, actually expense immediately startup expenses. I'm not sure that's bad policy. I understand it costs revenue,
yeah,
but it's putting the incentives towards starting up businesses right where they should be. At least, you know, I'm going to get my deduction when I'm paying the cash out.
Yeah. Okay. Thank you, guys.
Thank you, Mr. Schock. Mr. Marchant, recognized for 5 minutes.
Thank you, Mr. Chairman. I would like to follow up on some of the chairman's earlier questions. K1 partnerships throw off their earnings through K1s, don't they? And sub-S's throw, basically, it's a straight pass-through. So going back to the Obamacare tax and the P's tax that's attached to that, is it going to provide a disincentive for an investor to look at a small business, a sub-S, or a partnership, and know that they possibly could get a K1 or a pass-through income, that there will be no cash following those documents, so that they could be taxed? I mean, normally in small businesses, there is no requirement, is there, that the amount of income that you have to show on your income taxes as a pass-through is followed by any cash. Is that correct?
Well, that's correct, but I mean, if you would normally make sure that it was followed by cash as a contractual matter, either because if you were just an investor, you would make sure that cash distributions were at least equal to what you thought the tax liability was.
But in a C Corp, you can have earnings inside the corporation.
In a C Corp, you're perfectly right. You could have earnings and nothing to report unless you get a distribution. You just report your distribution. If you're in an S Corp or a partner in a partnership, you report your share of the income or loss of the S corporation or partnership, whether or not you got it. But on the one hand, on the other hand, typically you would make sure that, you know, either because you were part of the management or you thought about this in advance, that they did make distributions sufficient to cover your liability.
Well, if you're a passive investor in a partnership, then you usually don't have a lot to say about the general day-to-day.
Oh, well, okay, fine, but you would have a lot to say about the terms of your investment. You know, you want my money. Here's the circumstances under which I will make it.
In the discussion draft, it sets a $250,000 limit on the cost of new property and equipment that a small business can expense during the tax year, and immediate expenses begins to phase out once the taxpayer places more than 800,000 of that property into service in a year. These levels parallel those that were in effect prior to the stimulus. Do you think that these levels reasonably reflect the need of small businesses?
Well, as I said in my opening statement, from our client perspective, it's going to get most of them. You know, those limits will be sufficient for most. But it's very clear you can go buy a printing press. If you're in a printing business, it's going to exceed $800,000 or it can be $1 million. So it's always going to, no matter what the limits are, there's always going to be someone who wants more. And I guess that's the beauty that we have on this panel. We don't have to consider revenue impacts. You know, in a perfect world, I'd say let everybody write off their equipment no matter how much they buy in a year. But we can just say that because we don't have to balance a budget in Washington. But I think that's going to depend on the kind of business you're in. But I can say for a lot of our clients, 250 and 800 would cover most of our clients' acquisitions in a year.
Mr. Chairman, in the spirit of the Chairman Kemp's intent that the tax code be simplified and that the rates get lowered and we encourage the formation of small business, I think this is a very important hearing. I do think that the whole issue of the additional 5% tax on the K-1 and the sub-S income is a very significant thing in this whole formula. And I don't want to see us do anything in the tax code that will encourage people to go into C Corps instead of partnerships and sub-S's, because that's in my district probably 3/4 of the business is organized at that level. Thank you.
Ditto. Thank you, Mr. Marchant. Mr. Young brought up earlier ESOPs, and I know Mr. Neal is a big supporter of ESOPs as well. And you all know that in the draft, option 2, going to a single entity, we don't address the issue of S Corp ESOPs in terms of how we go forward on that. Have any of you thought of a way to do that? And the reason why I ask is what we don't want to do is have a detrimental impact on something that I think there's bipartisan agreement on, that it's been successful in our communities, in our districts. Mr. Nichols, you want to start?
I'd be happy to. S corporation ESOPs have actually been very successful in essentially expanding the base of ownership, essentially, and moving both frankly, both the profits and loss and risks of the business among the entire employee base, which, from the standpoint of inclusion in the American economy, has a pretty fundamental function. And so, as a consequence, doing what can be done in order to encourage that, it doesn't surprise me that there's bipartisan support. And you're right, I'm not sure I read anything in one way or another in the proposals. I'm not quite sure I would tinker with that. You do have, in order to have an ESOP, you would have to have a corporation, but the proposals don't seem to change that. So I would, if the policy is along the lines of, if it's not broke, don't fix it, it seems to be working very well. I'm not quite sure I would try to change that as part of these proposals.
Mr. Rubin, anything to add?
Well, I guess I would say that I agree that in general, S Corp ESOPs have certainly broadened ownership of S corporations and allowed employees to participate in that. I guess with a nod to Mr. Taylor, I'd say there's probably no conceptual reason why you couldn't craft a regime that allowed an ESOP to own interest in an LLC. But on the other hand, I don't think that there's a great need to do that given where we are today.
Okay. Mr. Taylor.
Just reiterate what I said is if you have a special rule for ESOPs, it ought to be across the board. You shouldn't have people saying, well, I've got to form an S corporation because that's the only way I can do an ESOP, as opposed to setting up a limited liability company. And so it ought to be across the board. I do think there is a fundamental issue about ESOPs, you give them a treatment that you do not give to other tax exempts, including regular pension plans, because there you would have so-called unrelated business income for many of these investments, and you do not when it's done through an ESOP. So you have another issue not related to this small business reform, if you will, about whether or not you are not giving ESOPs an advantage from a tax point of view that should not be given to other tax-exempt organizations, including other, benefit plans.
Mr. Harris.
Really don't have much to add to what's already been said, other than, again, if we've got something that's working, the last thing we want to do is do anything to make it not work. So I would defer to their judgment, but I think it's working, so let's just don't hurt it.
Okay. Any other members have any questions with our expert witnesses here?
Can I ask
You want to ask us a question?
No,
I'm going to defer to Mr. Neal.
I would not have the, I don't have the courage to do that, but I would make one point here that it's not working. Let's just start right there. The system is conceptually enormously messed up. I'm not talking specifically about ESOPs or anything like that.
What about the tax code? The tax
code and the particular provisions we're talking about, they don't work. And you ought to start from the assumption that there are serious flaws in them. And that is why, as I said before, there is a great deal of merit in focusing on option 2, even if you decide in the end you're not going to do it, you're just going to take the ideas and build them into option 1. It has the merit of making you focus on what's wrong.
Thank you. Anybody else want to add a comment? That's why we're having this hearing. That's why the chairman has decided to do these drafts, and we appreciate you for being here today and adding your input to this process. Appreciate the time that you have taken. That concludes today's hearing. Please be advised that members may submit written questions to the witnesses. Those questions and the witnesses' answers will be made part of the record. Again, thank you all for your time, for appearing today, for the thoughtfulness, for our, I think, wonderful educational discussion that we've had, and I think this helps us continue to move the ball forward. Thank you. This hearing is adjourned.
Thanks, Pat.